Good evening, all. I'm Epstein, and here we are with your SPDR ETF stock market wrap-up. And this wrap-up is for a pretty crazy trading day, but it's been a crazy month, to be honest. And it is October 26, 2023, Thursday. So, earnings season on fire. Most of the companies coming out beat, and yet the market's taking a beating, especially in the tech, especially in the FANG stocks. Why? Because I think the market, this is just my instinct on it, I think the market was expecting so much of artificial intelligence, and when it sees what's going on, it gets concerned. For the automakers, today we had an interesting day. Ford came out, and I was listening to the interview, on the earnings call and where they think they're at. What if I tell you they think that because of the increase in wages, the cost per car is going to go up? And I heard him say this, $850 a car. That's an awful lot. How do you cut that back so that if they have to eat something, it's not that amount? Well, they said by efficiencies, you have to figure out what they are. But then the more important thing to me was what I've said to you. And I was literally sat back in my chair. I couldn't believe that Farley said this and Mr. Ford over time. And what they're saying is, hey, this electric vehicle stuff is wonderful. The problem is people don't want to pay up for it. When something's brand new and you have a new watch, you get something brand new and people have money, they got money in the bank, they're going to go out and get it. They want to be the first one. Remember when we all got our first Apple phone? The lines around the block were insane. I had friends buying them, reselling them for double, but it didn't matter. Everybody had to get it. Well, a car, at first, Tesla took that share of the market, right? But as the other dealers are coming out with it, how many electric Cadillacs, fully electric, do you see on the street? Tell me. I see the Bronco. I see a few of the Mustang products, but not very many. Tell me about the rest of the companies that you're seeing. They're far and few between. Therefore, what's really happened is reality sets in. And you go, hey, I can get a hybrid or an ICE engine, and that's going to be for the price of the car 20-25% cheaper. People are going that route. Number two, the infrastructure isn't here in America. If you're going to drive an electric car 400 miles from here to Detroit, whatever it is from Chicago, you're going to think 3 times about it. Where are my stations? How long do I have to be there? What do I do? Versus I'll take my trusty ICE engine and there's a gas station everywhere I go. I just got to make sure I don't get, down to the last gallon that I have in the middle of nowhere. A very, very big difference. Give you another problem. Your electric car, EV, breaks down. Who's going to fix it? You're not going to your local mechanic. They don't know diddly about it, all right? You're going to find that out. Remember, I had a friend that went to a Cadillac dealership. He had one of the very first Lyrics here, has it, and the first dealership had no idea how to fix the car. It actually had to have a reset button that's buried underneath, and they found it in another dealership. So the reality of the system is Ford said, yes, we're going to commit $12 billion over time. But the key word's over time. We're going to push that back. We're going to do what we have to do with what we've got to make our profits while working on that. So the rush factor isn't there. Well, AI is pretty similar to this. People are looking at that. But what about the cloud? Eventually everybody's on the cloud and you get a saturation point. And we're seeing that in Meta, other companies that it has come into. There's nothing wrong with these business models. They're just maturing. And today, you can see how the market just let go with a gap to the downside. This has been a rough month. If you're trading this month, you tell me that you think your portfolio is doing good. If you're not a trader in and out, but an investor, you're probably down. Look at how this has just let go. You're now under the Bollinger Band. So, warning sign, you're getting too cheap. That's what it tells me. You've come down pretty hard from 332 to the 279 level. So you've dropped $50 on that stock. It's a big break. You're looking now for where's reality in the values. This is also doing something that you and I and others talked about months ago, that the PE ratios were too rich. And this last break that we're in right now, and I don't know if it's the last of the year, but this last break, the break we're in at this point in time, is taking down these PEs and bringing them back to a more earthly number across the board. You're oversold under the Bollinger Band. I'll let somebody else want to keep pressing the short side. I don't think I would tell my client to do that. Rivian staying down, and here's the argument that I have in the cars. That's why I went into it. So here's a market that came up, and as it did so, as we look at what this market was doing, I think I can get it to do that. I'm not sure. I want to come back and just see. There we go. I knew it would do it. All right. So here's a market that came up and just the other day got to 1984, flirting with losing the embedded reading, didn't do it, and back down for new lows. The odds are the market's going to try to get to that lower band if it stays like this right now. Trend down, bias down, and you got to be careful here. The 18-day average looks like it's getting ready to get under the 200. So you're lining up for even more bear action. Not a good sign for this company at this point. In UGA, we had the nice rally, got up to the 200-day average, and suddenly you've backed off to the 18 and the 2. Are we trending? Well, you do have the swing line up, but everything turns bearish quickly on you, just like that. If you take out the lows that we had on Wednesday of 60.05, I think it's 63.05, I'm sorry. If you take that number out here, what happens in very fast order is you will end up with the market with an inside day and then the lower low, and you do open the door for the 60-60 until you get back over the highs then of Wednesday. So Wednesday's range is going to be very important. In XLF, I see the trends are still down, but oversold. Maybe you reach down here, maybe not. But certainly there's no buy signals on the markets. In fact, you take a look at all the charts we're going to look at. They're all down hard. Now, does this throw out the idea that that early September lows, the October 4th low area, is now history? Maybe. I'm wide open to just maybe. It's not going to work. But if we rally, it probably means you don't get the rally that I thought you would get into year end, one of those really nice dynamite type rallies. I'm not seeing it now. Lower highs, lower lows, oversold in XLI. Total sideways action in AIC3. I mean, it doesn't get more neutral than that at this point. Then we come to the consumer discretionary, and is the consumer spent out? This is saying they are. And if we take a look, you can see where you're at. Now, did the market pay any attention to the third quarter 4.9% growth? We should talk about that for a minute too. People are convinced it's an anomaly. Doesn't mean it's a one-off event. It's a Taylor Swift rally. She toured. She made this $1 billion, whatever she made on it. I'm reading they're calling her the $1 billion girl now. And I think she's phenomenal. But when I look at just what it is, it's the event. In that quarter, everybody was on trips, going somewhere. I was one of the people. People were doing things. The summer was wonderful. You couldn't go to Europe. They were taxing you if you want to go into Venice. Too many people there. This whole event was happening, and that was that helicopter money. I don't know that that money's spent or not, to be honest with you. The consumer might not be in that problem. But on the fringe, we are seeing car loan delinquencies. We are seeing home delinquencies on mortgages going up. The credit cards full, and the average, is 25% on your rate. So if you got $1,000, you're paying $250 a year on interest if you don't pay it off, but multiply it up to $10,000. Now you're paying $2,500. Suddenly it's $400, $300, $200 a month, whatever it's going to be, depending on your balance. It gets to be important. And you see that that's weighing on this market. Plus, it's embedded. Still bearish. I don't see it changing. What about the home builders? So if you're looking at the home sales, we've already seen the new home sales right up there. The regular home sales, not quite the same way, because you don't have the flexibility of what the builder's doing, but the builder's making less money, and it just turned real bearish. You just had the 18-day average close underneath the 200. So good rallies in the market, probably going to be sold by the pros to see what it does. And if it's interest rates higher for longer, when the Fed has their talk come Wednesday, it's more of a nail in the coffin. I mean, yes, the home builders, the brand new ones, can do things, but they can't change the overall nature of the economy. Are people wanting to buy homes? They are. We're seeing it on the MBA mortgage numbers. We're seeing it in regular sales, and we're seeing it here. But you will run out of those people at these numbers, especially in the wintertime. Higher high, lower low, still bad. We haven't had one market that we're looking at and saying, hey, this is good, but gold. And I have been telling in the futures markets, my traders, that I don't even like the futures. I prefer the ETF. I want the margin, that 90% margin out of the market, because now you can hold on to it if something's going to happen. But when you get that 90% margin, what happens is the gold will go $10, $15 one way, and you're going, I can't stand that pressure. It's too much money on the margin that I put up. And I get it. This isn't the case here, and I appreciate that. So until the red line closes under 79, my door is open still for the 180s, high 180s in there, if Israel decides to invade, and we'll see what happens. You're only going to be able to hold them back so long to get these hostages, and after a while, we'll see what happens there. On the other hand, the siege is taking place there, and people need food, they need water. They're not going to get the fuel from the look of it, no matter what they try from Israel, which means humanitarian things are going to be terrible. Hospitals can't operate. What do you do? Because if there's no way to say that Hamas isn't getting it, and I think I'm saying that right, Hamas isn't getting, well, I got criticized. Somebody, like I said, like hummus. I know it's not hummus, it's Hamas. To make a long story short, they want to put pressure on them. That's Israel's game, obviously, so that the people say, hey, get out of our neighborhood. Get out of here. We need to get the food, the water, the medicine, whatever it is, turned back on. That's probably part of the overall game. But you did stop in silver. You didn't go anywhere. You pulled back, and it's not the same chart as gold. So don't try to say silver's the poor man's gold in this. No, silver needs industrial action. That's what it really needs, as copper does. Now, we still have the People's Congress going. Got to see how that's going to play out. Then we come to the bonds and notes. And like any other market, you can get bounces in an overall bear market. And we're not at 5% on the 10-year. We were in the 4.8s again today. We will see. The resistance on the chart is back to 85.40. The market is oversold. I don't see traders wanting to sell it, and there's no reason on the way that I teach charting to do so. You've got a bear market rally trying to develop. You've got the swing line with higher lows, higher highs, but 85.40 should be a resistance area in it. In the dollar, this has been a trade where you can just lose your shirt, and I think I've been clear on that here. I said with that sideways action, it's either side, and you're just whipping back and forth. I don't see how traders can, a trend-type trader is doing very well. And the same in FXE. If the dollar's that, the flip-flop is here, because 40% of the dollar index is made up of FXE. So, got to be careful. You put it together, you come up with a game plan, and that's what we want to do. In the mornings, I start off with a futures video where I cover 40 charts. Then I do the same in the ETFs, 40 of them. And we're going through everything, and in those, I will be very specific. I am going to say to you, buy here, sell there, do this, do that. That's how I want you to go about doing all this. And the reason is we're going to talk the morning fundamentals. We're going to talk like you hear me talk. I will at times talk, oh, we got earnings on this coming. We have that coming. You've got to see where this is going to go, the morning reports. But so many of the ETFs are futures-based that you want the combination. If you never trade an ETF, just go then for the futures video. But as you're seeing, like in the gold, I'm telling traders, my traders, and I'm very clear. I said, as much as I like gold on the futures, I don't want the risk there. I like the ETF better, and I think you can hold on to it better. So you use a little money management in those different ways. How do you get and find out about all this? It's pretty simple. It's iraepstein.com under the word research, or move your cursor right to the top up here. Got that? An icon will appear. Give it a click and away you go. I'm Ira. You have a good evening. I'll see you in the morning.